I am now joined by a man who says that the Emirates' current plight shows us we're facing a solvency issue and not a liquidity one. Well, he's Variant Perception's Jonathan Tepper, and he joins us now in the studio. Jonathan, first of all, thank you so much for coming here today. Now, I just wanted to go through some of the headlines that Margaret was mentioning just a couple of minutes ago, coming out of Moody's, saying that the UAE has plenty of assets to absorb losses. Now, when the story broke last week, it was very interesting. A lot of market commentators were saying, well, this once again is the fault of the rating agencies because they hadn't seen this coming.
Well, I think it's certainly the fault of the rating agencies, but I would also say it's the fault of investors as well. Investors always want to believe the best and often don't prepare for it. But I mean, in terms of the rating agencies, I'm surprised anyone listens to them anymore. I don't think Moody's or S&P would be able to find their way out of a paper bag. And, you know, it's interesting that their downgrades almost always happen after the fact. So I don't know of any new information that might be contained in a ratings report. But you're right. In terms of solvency versus liquidity, I think that the stock markets around the world have risen massively since the March bottom. And part of that is driven by quantitative easing in the United Kingdom, very large increases in the Federal Reserve's balance sheet. And that can increase collateral value, but ultimately it doesn't help the debtor pay the interest or the principal on the debt, which is what we've seen in this case.
So, Jonathan, what exactly will be the fallout of this Dubai debacle? Is it going to be in money terms, or is it more of the fact that people are going to have a stigma attached to Dubai? It won't be the financial hub of the Middle East anymore.
Well, I think in the case of Dubai, certainly it's hurt its reputation, and it's not systemically important. Abu Dhabi has more than enough cash to help. They have massive foreign exchange reserves. But I think that what's interesting is that it shows that anything built on very large quantities of debt that can't be serviced, will be affected. And so I think now, for example, last week, Greek bonds were selling off. I don't think Greece is in any imminent danger of default. But people are realizing now that if you have a lot of debt, ultimately you have to pay it back and retire it. It's easier if central banks can print money, but ultimately you have to be able to generate income to pay it down. And I think people will start shifting their attention to Latvia, to Ukraine, to the weaker members. And it's sort of like, the law of the jungle. The lions will always go after the weakest
But
animal.
Jonathan, I remember we were talking about this when when the Iceland saga happened. People said, oh, you have to watch out for the Eastern Europeans. They're small countries. We don't know exactly how much debt they have, and it's dangerous. Is this emphasized by what we've seen in Dubai?
Certainly. I mean, if you're looking, for example, last week, even though the stock market's up today, as they were just pointing out, credit default swaps are widening on some of the Eastern European countries. And there, if it weren't for the IMF, the EU, and Sweden bailing them out, Latvia would have gone bust already.
All right, something that we have to keep a very close eye on. Jonathan Tepper, thank you so much for joining us today.